We Indians love SIPs. As of November 2024, we Indians have invested over 1.85 lakh crore through SIPs in FY25. This number will almost certainly cross the 2 lakh crore threshold by the time this financial year ends, thus beating the 1.99 lakh crore number of FY24. Now, SIPs are undoubtedly a fantastic way to invest and create wealth. But with everyone talking about how great SIPs are, it is easy to fall for this narrative and ignore some of the finer nuances and challenges with them. Thus, from time to time, we do videos that can answer queries, dispel doubts, and break SIP myths. This video is part of that series. Hello and welcome to ET Money's YouTube channel. Today we will discuss 5 lesser known facts about SIPs. Now in our earlier SIP videos, we have talked about some crucial aspects of SIPs which are on your screen. I have mentioned the link to our SIP video playlist in the description so that you can watch these videos after this one too. Alright, let's start right away with the first SIP secret. The title may have shocked many. After all, aren't SIP meant to be rewarding? You invest in a disciplined manner over the long term and through market phases, so shouldn't SIPs reward your hard work? Well, take a look at the chart on your screen. It shows the 10-year SIP returns of Nifty 50 over various time periods. Now, in certain cases, SIP returns are rather spectacular. For instance, consider the period between 2000 and 2010, when the SIPs yielded about 22% average annual returns, or 2001 to 2011 when the SIPs returned about 23%. But there were many cases where the returns were good, such as 2002 to 2012 when the SIPs gave 16% per annum, or 2012 to 2022 when they returned 15% per annum. Then there were 11 to 12% cases, such as 2008 to 2018, 2009 to 2019, 2010 to 2020, etc. However, SIPs disappointed on 2 occasions. Between 2007 and 2017, they returned just 9% per annum. Between 2006 and 2016, they returned 10.6%. Now, this suggests that just because you have a very long horizon, SIPs will not automatically give you great returns. But why does this happen? Well, it happens because the markets are not linear. While SIPs help you average your investment cost, when you redeem your investments matters too. So if you redeem your investments when the markets are falling, your overall returns could suffer. Consider the 2 periods when SIPs gave lower returns. Towards the end of both periods, the market had declined, which probably lowered the final returns. Now, you can do 3 things to reduce the impact of a falling market on your redemption proceeds. First, be conservative with your return expectations. For instance, don't factor in 14 to 15% returns in your calculations. Instead, go for 10-11% and you will likely be positively surprised. Secondly, you can consider exiting equities systematically just like you enter them. So don't sell the entire corpus at once. Instead, do it in a phased manner. Now, if you are investing for a specific goal like its education where you can't extend the timeline, have an exit strategy wherein you gradually reduce your equity exposure and move the money into debt. Third, rebalance your portfolio from time to time as per your asset allocation. That will help you book profits at regular intervals and not wait till the end when the market decline can erode them. Okay, let's now move to the second SIP secret. But who likes low returns? Wouldn't it be wonderful if you start getting great returns within the first few years of starting your SIPs? Well, White Oak Capital did an interesting research on this. It found that whenever SIP returns in the Sensex were less than 8% in the initial 5 years, the total SIP returns over 10 years were about 18.7% on average. And when SIP returns were more than 8% in the initial 5 years, the total SIP returns over 10 years was about 14.8% on average. So, low SIP returns in the beginning are actually a good thing for the long term and vice versa. But what might be reason for this? Well, low returns in the beginning mean you are accumulating more units at lower prices. Eventually, as the markets recover, you stand to gain more. So don't lose patience if your SIPs don't work well in the initial years of starting them. Now, in the same report, White Oak also revealed that starting your SIP at the top or bottom of a market cycle has a limited impact on returns. But waiting for a market bottom to start your SIP did result in a diminished corpus. Now, depending on the SIP period, this difference ranged from 30,000 to as high as 48 lakhs. So, waiting for the markets to correct to start your SIPs makes little sense. Now, this brings us to the third SIP secret. Returns are the primary reason for investing. So, naturally, the higher the returns, the better. But in a practical sense, one should be more concerned about the corpus one would generate than returns. Let me explain this with an example. Let's say you start two SIPs. In the first SIP, you get a return of 14% per annum and you keep contributing the same amount, say 5,000 throughout the SIP tenure. Now, in the second SIP, you get a return of 10% per annum and you increase your SIP contribution by 10% every year. After 20 years of doing so, you accumulate about 15 lakh more in the SIP, giving you 10% returns. The difference in the final amounts is due to the higher contributions you have made yearly in the second case, and that made the compounding's impact on your money even more powerful. So the point is to focus on investment part and less on the returns part. Of course, I'm not saying that you should ignore returns at all, but returns from investment are beyond our control. But we can sure control is how much we invest. Now, in the end, the corpus accumulated matters more than the returns generated, as it's the corpus that you will eventually use, not the returns. Okay, now let's move to the next SIP secret. Whenever the markets rally and touch a new peak, investors invariably wonder if they should stop investing and pause their SIPs. The logic is to restart investing when the markets correct a bit or when the euphoria cools down. Now, we considered 4 cases to see if stopping SIPs at market highs works. In the first case, an investor did SIPs of 10,000 in Nifty 50 for 20 years, irrespective of market levels. In the second, SIPs were stopped for 2 months when the market hit a new high. In the third case, they were stopped for 4 months, and in the fourth for 6 months. So what were the results? Well, there wasn't much difference in the returns. The investor who did SIPs without any interruptions generated 11.94% per annum. The one who stopped SIPs for 2 months got 11.93%, and the other two received 12.03 and 12.05% per annum respectively. However, there is a significant difference in the final corpus. Now, as we discussed in previous point, it's the final corpus that matters more than the returns. A 6-month pause resulted in a diminished corpus of 76 lakhs as against 91 lakh for uninterrupted SIPs. So, it makes little sense to stop your SIPs when the markets rally and hit a high. But how can you reduce risk then amid bull runs and heated market conditions? Well, you can rebalance your portfolio to restore your desired asset allocation. That will take care of profit booking and also reduce your risk. But avoid discontinuing your SIPs as they can compromise your goal amount. Now, by their very natures, SIPs average your buying price in the long run. So you need not start and stop them based on market conditions. And this brings us to the last point of this video. SIPs are usually talked about in context of equity funds. But what about investing in debt funds via SIPs? Well, we checked the 10-year SIP returns versus trailing returns of the largest funds of 3 debt categories across volatility spectrum: overnight funds, corporate bond funds, and gilt funds. Now, overnight funds are least volatile and gilt funds tend to fluctuate most with the interest rate movements. Corporate bonds lie in between. Now, across all categories, trailing returns are more than SIP returns. So, SIPs don't seem to have any edge over lump sum investments in case of debt funds. But why is that so? Well, SIPs work well when the underlying asset shows high fluctuations. That allows you to average your buying price as you invest. That's why SIPs are good for equity funds. On the other hand, debt funds tend to be comparatively less volatile than equity funds. Their NAV growth tends to be in a straight line. So SIPs in debt funds tend to be invested at higher and higher NAVs, thus pulling down the overall returns. For instance, take a look at the NAV movement of SBI Overnight, HDFC Corporate Bond, and SBI Magnum Gilt funds. Now, given this characteristic of debt funds, SIPs make little sense in case of debt funds. But if you have been doing SIPs in debt funds to accumulate a corpus for a short-term goal or to build an emergency fund for any other purpose, by all means continue doing so. That's because SIPs have other psychological advantages too. They help you build a large corpus with small investments and instill investing discipline. When you see your corpus gradually building up, that itself creates a positive feedback loop, which motivates you to continue investing. And that's what makes SIPs an effective mode of investment. And with this, I have come to the end of this video. I hope you found it useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.